at exercise 8. So it says on May 1, American Gold Exchange paid cash of $54,000 for computers that are expected to remain useful for 3 years. At the end of the 3 years, the value of the computers is expected to be 0. Calculate the amount of depreciation for the month of May using the straight line depreciation method. And then record the adjusting entry for depreciation on May 1st. So let's calculate the depreciation and what's expected. So it said that we paid cash for computers, all right? So we paid cash of $54,000 for our computers. That was the cost, all right? That was the initial cost of our computers. And it says they're going to have a useful life of 3 years, all right? And then the residual value, what they're worth at the end of the useful life, is 0. We need to know all that information, okay? So to calculate the straight line depreciation, we're going to take the cost minus residual value, and we're going to divide that by our estimated useful life. Okay, so for this calculation, we're going to take 54,000, and it's minus 0, and we're going to divide that by 3 years. All right, so 54,000 divided by 3 tells us that we're going to have depreciation expense every year of $18,000. Okay. And if we want to get this on a monthly amount, we're just going to divide this by 12. Okay, so we're going to take 18 and divide it by 12 months. All right, so this is my monthly depreciation. We calculated the annual depreciation here. All right, so our monthly depreciation is $1,500. Okay, so now that we've figured out what the monthly depreciation is, it says record the adjusting entry for depreciation on May 31st. So we're going to have May 31st on our journal. So we're going to do May 31st. And anytime we make an adjusting entry for depreciation, we're always going to debit depreciation expense. I'm going to identify it for the computers. And we're going to credit accumulated depreciation. It was $1,500. All right, so there's our journal entry for calculating depreciation. All right, so now let's look at, now that we know what the depreciation was and what the cost was, let's look at if we made a T account for that account. So computers, we've got computers here. We purchased it on May 1st. So we purchased it and it was for $54,000. And we recorded depreciation, and that's going to be kept up in a different account. So accumulated depreciation over here, we're going to credit that $1,500. And those are our balances in our T accounts. Okay, so we got computers and accumulated depreciation. Well, when we calculate net book value, so net book value equals the cost of our asset. So the cost of asset or assets minus the accumulated depreciation. So for the computers, we're going to have $54,000 minus $1,500, and that's going to give us the book value of $52,500. So that's our book value, and that's the value that would be shown on the balance sheet, is this one right here. Okay, so there's our net book value. All right, if you have any questions on calculating net book value, send me an email or post any questions you have to the questions discussion board on Cougar